Record. There we go. Good evening, everybody. Welcome. Thank you so much for joining us. I always love having a live format to be able to chat with everyone in real time. So welcome to part 2 of my webinar with Mark and Andrew. And the first one went so incredibly well that we had tons of people and we were absolutely overwhelmed with questions. So we decided to do a part 2 and bring the guys back because I promised you we were going to talk about how to build the ideal portfolio. And I feel like we touched on various pieces, but there's definitely some more nuggets that I want to get from you guys. And Mark, I know you do a lot of YouTube stuff, so you get to talk about yourself and some of your things. But Andrew, I'm hoping we can dig a little bit deeper than you get to in your podcasts. And
you know, Andrew does a lot of YouTube stuff too.
Yeah,
it's just podcast format though. But yeah, that's on YouTube.
And the thing is, I think part of the reason why people are so excited to join an event like this is because they actually have the opportunity to ask you questions live. Mm-hmm. So it means that they get, when people have issues or people have questions or they're wondering what to do, a lot of stuff with real estate, I think, is time sensitive. So this is a great opportunity to be able to get some live content and share opinions. So give me 1 second here. I'm going to do a screen share and you'll have to bear with me there. Can everybody see that? We're good?
Yep. Are we live on Facebook as well?
Yes, we are live streaming in the mastermind group just for overflow in case we go over in the meeting room in the Zoom as we did last time. So we are here this evening. This is Building the Ideal Portfolio Part 2. Thank you so much for joining us. And as always, thank you to the gentlemen who have been so kind to spend another evening. So my name is Elizabeth Kelly. I've been a real estate investor. I was doing the math. It's about 15 years now, which is kind of crazy to me because I can't believe this is so much has happened in the last 15 years that I kind of look back and it's absolutely mind-boggling. But my specialty is buy, rent, and hold, rent to owns, and I have done some flipping and some wholesaling. I was also a trainer for Rich Dad or Legacy. I was an elite trainer there. I taught the lease options course and I taught the momentum course, which is the course that all new investors take. So it's the foundations or the basics of how to invest in real estate. And then for those of you who don't know me at all, I live in Kirkland Lake. I am the owner or manager of about 400 investment units. So I definitely am kept busy between the property management, the rent to owns, and all the other fun stuff, my coaching. Definitely a busy lady, but always love to hear from people. So next we have Andrew, and Andrew has the Andrew Hines Real Estate Investing Podcast. Definitely one of the most dapper investors we have out there right now. Just look at that suit all done up. And Andrew, one of the reasons I love talking to Andrew so much is because he is a true numbers guy and you absolutely understand the fundamentals and the economics behind what happens. A lot of investors, we sort of hear things or we learn, okay, well, when this happens, then this is what it means, but you actually understand the whys. And that's why I love listening to all the content you put out there, Andrew, because I feel like it's good, solid information founded on reality, based on numbers, and I trust what you have to say implicitly.
Thank you.
And then, of course, we have Mark Loeffler, the guy who really doesn't need much introduction because you are all over YouTube. Like, you have it in the bag there, Mark. You always got great content, tons of insight, very active realtor specializing in investment properties, as well as having a large portfolio. And the original inspiration behind our time together was, to talk to Mark and figure out why he's selling his investment properties and what he's going to do with the money when he sells everything and where he's going to place it all. It's always interesting, so many people in real estate do stocks and they do real estate. And it's always interesting to hear, how do you decide where to put your money? How do you decide whether it's better to buy stocks right now or better to buy real estate, and those kinds of strategies, those kinds of ideas. So if you haven't checked out Mark's YouTube channel already, please do so. Ton of amazing content there and great information. So we started our webinar last time with a series of 6 questions, and then I anticipated that from there we would open it up to people, and if we needed, then we would allow people to ask questions, which I think is a great a great idea. I just wasn't quite prepared for how enthusiastic people were and how excited they were at the opportunity to pick people's brains live. So we're going to back it up a little bit. And I know we talked about our current portfolios. What I would like to spend a little bit more time talking about this evening is what factors need to be present for you to buy a property, and then what are the key indicators that it's time to sell a property. Because I've seen a lot of conversations recently, especially in the Canadian Real Estate Investing Mastermind Facebook group that I host, and people are like, is this the time to sell? And I think, Mark, if we asked you, you'd be like, it depends. And Andrew, you'd be like, it depends. But the reasons why it would depend will vary for both of you. So that's where we're going to start for this evening. And I'm just going to stop screen sharing here for a second and go back to the chat. So just a reminder for everyone, thank you so much for joining us this evening. We're really excited to have you guys come back again. And just a reminder to be able to take part in the conversation, by all means, join us in the chat box. Just use the drop down where it says 2 at the bottom, and then you can choose all panelists and attendees. You can choose all panelists. We don't want that. We like all panelists and attendees. And then you can message people privately as well. And then if you have a specific question, we do have questions left over from the last webinar, which we have carried forward. But if you have anything really urgent that you'd love the guys and myself, you're stuck listening to me too. So love for you to throw it in the Q&A section. But just remember, the Q&A is for specific questions for the panelists. The chat is where we get to interact and have fun with you. And one of the reasons I like these guys, Andrew in particular, super techie and gets on and just chats with everybody anyways in between questions. So love that. Thanks guys for joining us this evening. And tell me about, I guess, Mark, we'll start with you. What would make you decide to buy a property? Or maybe we need to ask you why you're selling and then you're buying again. So what would make you decide to sell or buy?
I'm selling and buying. So I have a portfolio of 7 properties with one investor. He decided it was time to sell. To be honest with you, we were probably going to pare down some of the portfolio anyways, some of the smaller stuff, and move on to something else with that money, or pay down some debt, do whatever. Anyways, and he just said, well, I kind of want to, for whatever reason, get out. I'm like, okay, well, now is not a bad time to sell, obviously. We sold 6 out of the 7, everything less than a 3 cap in Hamilton. So yeah, I mean, obviously there's a lot of upside on rent still, but we took a lot of that off the table with what they bought it for. So without doing any of the work, we got a lot of the value. And now I'm under contract for a 15 unit out in Alberta. And some people will say, well, that's where I'm going with my money, but I totally joint ventured that one as well. It didn't take very long after I got the accepted offer to find money. And so, yeah, I'm heading out there tomorrow to do a walkthrough of that and look at a whole bunch more stuff. And yeah, we'll see what happens.
That's amazing. So would you always recommend to investors that when your partner wants out, you sell the building? Or is that just like normally you would try and refinance?
No. So I have a shotgun agreement with everyone that I do a deal with. And basically, I could have shotgunned them, but being the poker player I am, I devised that if I shotgunned him at what I needed to shotgun him at to buy him out, then he probably would have just turned around and said, no, I'll just buy it. And then if I shotgunned him at the value I could actually sell it for, then to be honest with you, it didn't make sense financially for me. So I was better off just selling them, pay the taxes, take that money, do something else with it, and go buy either more properties in Hamilton, Southwestern Ontario, or other places.
Absolutely. So I assume you're buying in corporation. So would you fully shut down that entire corporation and that would be the end of it? And then you would open a new corporation for your new joint venture? Is that how you do it? That
is correct. Yep.
Perfect. Okay. That's a good tip for everybody.
So buying my new stuff in Alberta, I have an Alberta Corp. Mm-hmm. That is the Alberta Holding Corp. And then each joint venture will have its own corporation. If I do more than one investment with the same exact group and the exact same profile, I would probably keep the that one corporation just for cost sake.
What's your threshold in corporations? Because I know you're going to look at a bunch of units. So let's say, do you have a magic number? Like, I wouldn't own more than $1 million in one corporation, or let's say you buy a building for 750. You know, how big another investment would you put in there to save money? Because then your liability is going up the more you mix, right?
Well, let's be honest. I'm not looking at anything less than probably like this one at 1.3 is probably the cheapest one I'm going to buy. And like we had close to $30 million in the one we had in Hamilton.
Gotcha.
I mean, I don't, like, we've had slip and falls at some of our properties. We've been sued, but it goes to insurance, right? And like, we hire people to do it. They have $5 million liability. We have liability on ours. It's, I don't, yeah. I mean, from that standpoint, if I'm working with the same people on every deal, then we're just going to keep that same corporation.
Perfect.
Whether there's $100 million or whatever in there, doesn't really matter. It's more to do with who's in the deal.
Absolutely. So have you looked at other investment strategies? Like, would you, for example, do private lending or anything else, or all the capital that you get out of your multis, you're going to turn around and buy multis again?
All the capital I get out of my multis, I'm going to invest in the stock market.
Oh, well, there's that. Now, isn't there? Now we're getting to the meat of things. So
well, maybe.
Yeah.
I like, unless, well, and then I take some of the profits from that and funnel that back into real estate. I'm not a big proponent of private lending, just for the simple fact that I want to be diversified. And like, I can go buy real estate without any of my own money, and I can give people a great return on that. And you know, that they're happy, I'm happy. I can keep doing deals, and I've never been limited on the size yet. So I use that money somewhere else to make a return and diversify.
Gotcha. Absolutely. That's fantastic. So where are you finding these deals?
In Alberta or here or where?
Both. We have a question from someone who said, asking how to buy infill or development lots. They never seem to appear on MLS or wholesalers list. But I find that that's just one particular strategy where people just aren't finding deals right now. I mean, the numbers, they're struggling with cash flow. You know, the 1% rule is like, so 2019. And
well, I mean, you go and look at it, and deals, there's tons of deals out there. Like I forget who it was, but some investor contacted me on Instagram, and they saw one of my stories about how to find commercial properties. And I use CoStar, and it basically gives you all the owners' names. You make a list of them and you call them, right? And it's just good old fashioned dialing for dollars. You want infill lots? I mean, I just did a video with Ryan. What's his last name, from Oshawa? Yeah, Ryan Carr.
Yeah.
He sends 15,000 flyers every month.
Yeah.
Right.
Oh, he's paying for marketing to basically find his own. Yeah.
And he's still getting them on MLS. He bought one on MLS for 370,000 that he's turning into 2 legal triplexes.
That's incredible.
Right? So 370 does the build. They're worth 1.2 each. Right. And we talk about that on the video that we just did.
I think people have an idea that, you know, they spend maybe a few weeks or a few months, and in, you know, with how hot the market is right now, they don't find anything. And I think sometimes, and correct me if I'm wrong here, guys, like, tell me in the chat, but do you guys start feeling like you're missing something, or like there's something wrong with you? I remember that feeling when I started out. I don't know if you did too, Mark, but I remember feeling, you know, I've gotten my education, I know what I'm looking for, and like, I can't find it. Like, what's wrong with me? What am I not doing here? But I think, you know, that's one of the signs to me of an investor who has some experience behind them, is they're a little more relaxed, and they're a little more kind of, when the opportunities, you know, I'll find the opportunities when they're there, or I know I follow this process and the opportunities will come after that. Like, I don't see Ryan Carr very often saying, you know, I have nothing to do with my time. So I think
he is saying it's getting tight.
Oh, it is. It's getting tight. There's no doubt about that. And you know, 15,000 flyers a month, it's not free.
No.
So he's investing a lot to find his next deals.
100%, and a lot of time too, right?
Yeah.
And you know, one of my great strengths has always been networking and getting on and doing YouTube and doing different things and just saying, hey, this is what I'm looking for. Who has something? And I'll get, I think it was John on here from Fort McMurray last time. He sent me, well, he said he might sell a building. And I said, oh, great, send me numbers, John. You haven't sent them yet, so I can't buy them until you send them. Just letting you know that. But like the stuff like that happens all the time, right? And so it's just opportunity, and I get to look at it first and then see what we can do with it.
Absolutely. Absolutely. Well, thanks, Mark. I appreciate that. That's some good information to get us started. Let's shift over to Andrew, and we'll let you play and do some chatting with the people who are here, Mark. And Andrew, what are you up to these days? What are you looking to buy, sell? Are you holding? How are you keeping yourself occupied in one of, if not the hottest markets that we've seen?
You know what? I originally was just kind of hold pat with the student rentals. But since it's been hot, I did sell one of them sort of intentionally. And then I got a couple more offers on a couple other properties without listing them per se. And so I basically just decided to sell a couple more. And I'm looking at the Florida market right now, but really I'm just looking for cash flowing opportunities. And I know we're just talking about kind of the FOMO, a lot of people feeling like, I got to be doing something. And, why can't I find something? Mm-hmm. No one should be beating themselves up in the Ontario market right now if they're finding it hard. It absolutely is. And my mentality is more find a way to push my business downhill and find a market where it makes more sense, where the cash flow is potentially better. So I like, we've talked about a lot of different economic kind of factors that I would look for. But I mean, of course, the absolute must, which won't come as a surprise, is cash flow. So I'm looking at potentially opportunities to do Airbnb down here, and there's full management service available. And I'm at the point where my brain is like mush after the phone calls I've been making today, just talking to property managers, lenders, absolutely everybody that would be involved. And if I can make that model work, and I have a really solid contingency plan of just renting it out on a monthly basis, if for some reason leisure dries up, because we all know in an economic collapse, the first thing that's going to dry up is the unessential purchases, which leisure spending for sure. Florida is definitely a hot commodity though, in terms of like people want to be here. There's huge in-migration here, largely driven by the politics, the warm weather. And, we got companies that are wanting to come here as well.
Zero tax, state tax.
Yeah, zero state tax. There's just so many reasons to want to be here. People are fleeing places like New York to come here. So to me, there's a huge opportunity. I'm seeing signs of what happened in Ontario in 2017 happening here. They're in an inventory crunch. I don't buy based on speculation. Based on appreciation. It's got to work as is, but I certainly don't mind being in a market that I think has a really strong future. And even in a downturn, I still can't see people wanting to stop coming to Florida. And and just asking around and talking to a few people, I've basically gotten the feedback that even back in 2008, rents didn't really fall when the values kind of fell out of the market there in 2008. Their rents actually stayed relatively steady because people who would have been, and I'm definitely exploring that. I'm open to other opportunities, but my main intention right now is to get some money onto the other side of the border, get it down here, and then go from there.
That's amazing. I love that. So it's always interesting to me. What is it like to be a Canadian looking at investing in the US? Like, obviously you're going to need a whole different power team and you have to get used to a different structure. What does your financing look like for down there? Do you have lenders who will lend to you, or are you literally coming in with private money to be able to fund US stuff?
I think that there's an understanding that, or people seem to think that you can't get financing down here. You definitely can. Mm-hmm. It's just they would refer to you as a foreign national and you would pay potentially more. However, if you get over, say, $1 million loan amount, if you get some of the institutional, like the Fannie Mae, Freddie Mac, they kind of act as sort of CMHC in the deal. You can get the same rates as Americans get if you get into the larger multifamily. So there are a lot of different ways to do it. Now, I'm definitely going to explore the opportunity. I am still exploring the opportunity of getting an investor visa, in which case I could get a social security number, and I would also be able to get like best in market rates. So like I said, a lot of analysis, a lot of research right now. And it's a lot of work. It's kind of frustrating when, someone like myself, I've done so much work in the market that I'm most active in or have been most active in. To start all over again can be a bit frustrating, but I will say this, having done it before, there's a lot of shortcuts. Like you start to realize it's all about network. It's all about just get on the phone, find the who can tell me this, who can connect me and make this easier. And I've been so fortunate to have people such as yourself who are in my network, people who are in the US already investing. They're Canadians investing in the US. And heck, Glenn Sutherland has a podcast called A Canadian Investing in the US. So it's probably never been easier to try and do something like this.
Yeah. Well, definitely in the world of social media and the information age, I mean, when I started, and Mark, I'm sure you can relate to this as well, because you were already well established when I started investing. But I mean, we would drive to our realtor's office and sign all the paperwork, and, heaven forbid you couldn't be in the same place, because then you'd have to fax it and you'd get the ugliest, crappiest thing that then by the time you finally agreed, you'd have to go and do a clean copy because you couldn't read anything. And, if you wanted information, I mean, it was really hard. The US has definitely opened things up a ton. And they've made it a lot nicer, in terms of you can see the tax roll right online, and you can see, they do tax liens and everything there. Everything's online. They were much more advanced than we were, and their privacy rules aren't as strict. So, flipping and wholesaling is much easier in the US because you can literally grab the lists of people who aren't paying their taxes and call and make offers to them on the spot. So it definitely, the information age has made it a lot different to be able to connect with people and to be able to build your network in the US. That's amazing. So I assume you're going to set up a corporate structure down there as well?
Yeah. I've just, again, been on the phone with so many people. I was speaking with an accountant in the firm that I've been dealing with for, I think, almost 10 years now. And they do cross-border. They've done cross-border for me in the past. So this would be my second go around investing in the US. So I knew some of the stuff. I already knew the rough corporate structure that I was going to use, but I'm also talking to immigration lawyers just about getting the investor visa and just making sure that I can satisfy both. So I can't stress enough how much you need a team to look at this type of structure and make sure that they're all, being considered, right? You don't do something without consulting your lawyer and your accountant and make sure they all understand.
Yeah. I actually have deals that I've walked away from where I wasn't able to find a property manager where the numbers worked. And your property manager, I mean, they can make or break your cash flow. Like, we spend a lot of time talking about, how important our accountant is, how important our lawyer is. Those guys are really important, especially in the beginning when we're acquiring. But if we're going to hold on to a property long term, your property manager is going to make or break you. So you have to make sure it's someone you trust and someone who can, provide the services you're looking for. I mean, I had one property manager when we were starting out, when I started really auditing what they were doing. I mean, I paid for a new toilet in the same unit 3 times within 12 months. So either there's a problem with the plumbing, or somebody's just, say we put a toilet in there and we really didn't. So.
Yeah, I can't stress how important the property manager is. Like you said, they can make or break you. I think you need to be in this business. You need to be ready to fire quickly if people don't perform, and make sure you structure your agreements. I know you see the number there. It's gone now, right?
Yeah.
Make sure you structure your agreements so that you can that you can get out of it, right? If you're not content with what they're doing, you can move on to the next. Because I don't know if you heard my story, and I'm sure many have, but in Ohio, my property manager allowed my property to be destroyed. He stole my money. He collected rents and didn't give them to me. And he was the most polite guy on the face of the earth. I'd be like, "Hey, Tom, can I get my money for that now? And, do you think we could square up on like all the money that you owe me?" And oh yeah, sure, we'll send you the statement next week. And we'd have that conversation every month. And then eventually I just had to walk away from it. He didn't have anything. So I thought about suing him, but this is the type of thing. It's weird, but I mean, down here, you could have somebody that you know, for excuse the expression, but they're screwing you and they're making you feel like you're screwing them while they do it. That's that's the thing you've got to kind of expect, and you got to be very careful. And people who follow me know I'm very adamant on being able to take control of the situation, and I am that way because of the things that have happened in the past. But I've probably stopped myself from losing a lot of money that way. However, if you want to grow, you do need to learn to trust people. You do need to be able to delegate. And so keep a close eye, make people earn your trust, and then you grow from there.
Absolutely. That's some great feedback. I think too, I've found, you know, in my evolution as an investor, you know, when I started out, it was all about, and this kind of goes to what you're saying, Mark, is the best deals aren't always the best opportunities. I spend a lot more time now focusing on people than I did before. When I started out, it was the numbers, the numbers, the numbers. And now I spend time thinking about what is this particular property? What is this particular investment? What is, you know, this partnership? How is it going to impact my life? What is it going to do for me? And if I don't like someone as a person, I'm not going to want to invest with them as a JV partner or not. And so my criteria, my decisions about how I get into it, or how or why I get into a property, and then why I would choose to sell a property have changed. And definitely, you know, not having the team of professionals around you can have a tremendous impact on getting in and getting out.
Yeah. And just, I guess, to Paula in the chat there, you'd asked, like, overanalyzing deals. I mean, so Andrew said he's kind of brain dead because he's been working on stuff all day. But when he goes to analyze a deal, he'll look at it and say within 10 minutes if it's a deal or not. I looked at the Edmonton deal and I said, yeah, it's a deal at this price. If I can get it for this price, I'll buy it. And, you know, because I know basically the financing structure and stuff like that, right? But it's then seeing that it's a deal for me because I can go ahead and average rents on this property are $850. Average rents for a 2-bedroom are $1,300. I can come in and do some renovations. I'm going to be at average or above because I create nice units. And, you know, so there's that upside for lift of $500 per unit. And that by doing that, I can add a lot of value. Or, you know, like if you're looking for infill lots, well, what are you looking for? You're looking for 50 by 160? Go look at all the 50 by 160 lots out there and then just go door knock them, right? Or call them. You know, so like it's finding the deal where other people don't even see the opportunity.
That's
right?
That's
So
a really good point, Mark.
Yeah, you're always missing out on the best opportunities is because you're not doing the deal correctly. Like I've been told so many times I've overpaid for apartment buildings, and I just said, and by pretty seasoned investors, and I'm just like, okay, I'll be okay, thanks. Mm-hmm. And like years later, I sell them for double or whatever, and I've made cash flow the whole time. And you know, the one I probably got 10 phone calls. I bought this little 9-unit on the mountain for like $1.4 million on Fennel, and I bought it cash. There was 5 vacant units. I basically turned all the vacant units and I got a 6-1 available. So by March, I closed in January. By March, I had turned all the units, I'd rented them out. So by May, I had basically got a valuation of 1.9 million on it. And I had all my money out.
That's incredible.
Right, but I had overpaid.
I think sometimes people when they're starting out, and you know, I've been in this situation, so I'm not in any way judging, but I think when we know more, we do better, if that makes sense. So, you know, when you're starting out and investing and you don't really know what you're doing, you know, if someone comes to you and says, you know, my aunt has a house and she's passed away and, you know, it's all hoarded in and blah, blah, blah. Can you help me with this? You know, when you don't really know what to do, you look at that and you think, well, this is a wholesaling opportunity. I'll find somebody who wants to buy it to do renovations to it and I'll make $5,000. But when you increase your level of knowledge, when you consume as if that's your job when you're starting out in real estate, then, you know, you get your feet on the ground, you get your power team in place, and someone comes to you with that very same deal and you go, well, I'm going to do the flip on this. and then you learn more and you do better, and someone comes to you with that same deal, 6 months later, when you learn how to do rent to owns, and you're like, I'm going to buy this property at a discount, I'm going to do the renovations, and I'm going to turn this into a rent to own and sell it in 3 years. And your property, you could make 5,000, you could make 50,000, or you could make 100,000 on that same property, but it's strictly based on your knowledge and your network at that point in terms of being able to make more money. And I think, Mark, that might speak to what you were saying in terms of looking for opportunities, and it's recognizing opportunities that are there. If you don't know how to analyze investment properties, if you don't know how to look at a property and find the highest and best use for it, then definitely you're going to run into challenges wondering where all the deals are.
Well, obviously you must have watched that YouTube video with Ryan Carver, because his highest and best use was the name, because that's the name of his book that's coming out, right? So
that's awesome. It's actually, I started using it a while ago because I stole it from Quentin D'Souza. But it makes a lot of sense because they use it a lot in the world of, what's the highest and best use of your time? And then I started going, well, what's the highest and best use of this property?
Yeah, for sure.
To that note, it's creative versus competitive in a lot of ways, right? Like once you're using your skill set to think about how you can add value in a way that not everybody else thinks about it, you stop competing with others and you start taking a deal that other people aren't even looking at, or as Mark put it, people think he's paying too much, but he understands what he can do. And I think some of you will have heard this before, but I bought a home in a heritage neighborhood, but I made a good relationship with the heritage planner. And I had an angle where no one else wanted to deal with this house, and I was able to do it. And it was the most profitable flip I had ever done. And, had I not done the research and made the connection, I would have just been competing with everybody else paying too much for properties at the time. But instead I got this property probably for 70 grand less than I would have paid for it if it was just on the other side of the street. And this was at a time where you could still buy stuff in the 200s. So it was a significant price difference.
Absolutely. And I think a lot of it, going back to working with people, when you're working with a seller and you're listening to what it is they really want. I've talked to a lot of sellers who will take less money for better terms and conditions.
Mm-hmm.
Well, I mean, my 19 unit I bought for $950,000 in Hamilton. He had an offer of 1.2. This is way back in the day, guys. This isn't last year or nothing, right? And this was like a crackhead infested property. It was brilliant, best deal ever. And if you guys are in Hamilton, go there, because Caro's there now, and eat at the restaurant, because we need your support. But I bought for $950 when they had an offer of 1.2, but I was all cash, and I was closing in like 3 weeks. I had no conditions other than a walkthrough of all units. And they just let a deal fall through on inspection because, we all knew it was a piece of shit. And I was like, okay, I'm going to come in and do all the wiring, I'm going to do all the plumbing, I'm going to put all new heat throughout the whole building. Like, I'm okay. I don't care what it looks like. I just know where it is. And for $950,000 for that many units, I'll be okay.
That's awesome. A good story. I love those stories. Okay, so we have some new questions here. I think we have a couple of minutes before we move on to our sort of next block of questions. So David said, can Mark expand how you would JV with paying a partner a percentage and structuring? You mentioned it briefly last week as opposed to the usual 50-50.
Yeah, so this last deal I did out in Alberta, out in Edmonton, basically I put it out to my investor list, and we are selling 4 shares, basically at 6.25% of the deal, 6.25% of the deal for $175,000, and that gets them 8% preferred return and 25% of the overall deal. The total raise is $700,000. Does that answer, David? I don't know.
Is that, are those numbers sort of a standard for you, or did you customize those based on this individual deal?
No, this is basically, so when I was going through the exercise of thinking about buying my partner out on those 7 properties. It was basically, okay, what's the deal structure I can do to not be in the position where I ever have to sell again? And, so this was one of the ways I could do it, because now I can have it where I'm not so reliant on one big investor. And I'm selling shares, obviously. So, if somebody wants out and they have like 50% of the deal that I've put in, then really it's, 350,000 plus some interest, rather than, the whole 700. And then, I get stuck at the point where I don't want to sell, or it's not advantageous to sell. And, and I can't or don't want to meet that obligation.
And we're sort of in a situation here where we had a JV partner. We started with our JV partners years and years ago, and the financing rules were very different then. And trying to refinance properties now, when you own multiple properties with the same investor, your hands can become tied. It can be very challenging to refinance properties.
That's why I like commercial financing, because the bigger you are, the more they like you.
Yeah, that's a good point. So Jeff had a question which Andrew answered. He said, is it better to partner on 2 properties or go solo on 1? Andrew, do you want to expand on your answer? Then we'll let Mark dive in.
Yeah, sure. I mean, I just think personality is the biggest thing. I mean, every time you add somebody into a deal, you have an entirely different dynamic. Now you have to communicate with that person. So it's adding a new relationship into your life. And if you pick the wrong JV partner, you could have a really uncomfortable situation where it really actually keeps you up at night, does a lot of things. So I've had not so great experiences on that front, and then I've had a really good one. So if you pick the right partner, your life can be fantastic, and there's a spectrum of everything in between. So to find 2 great ones is just going to be more challenging. Do you want to go there? You certainly can. A lot of it comes down to the expectation you set at the beginning, like what level of involvement, and making sure that whoever's investing with you, if you truly want them to be a silent partner, that they understand that this is kind of the terms, and it's all outlined clearly in the agreement. Mark would probably be far better at outlining exactly how to set that up, since he's done it so effectively here.
Yeah, and well, I mean, so I guess the question is, do you invest your own money in one, or do you partner with somebody? And this is how I'm taking the question. Or is it better to, go ahead and invest your money in another one with somebody else? I would tell you to invest in one, become an expert at doing it, and then your next one, then you bring in a JV for that, and then you still own 2 properties. You own one outright, and you own one, whatever you can negotiate. Like if you own 80-20, 50-50, 60-40, whatever that deal is that you can do, that you just start getting that joint ventures down, and you can grow that much quicker. I mean, but you look at Kellen James, right? Kellen James owns, I don't know what he's at, like 60, 70 doors. And like he's never joint ventured in his life. He had a good job. He was able to get many mortgages. He lived frugally. He was in the fire movement, so he didn't spend a lot of money. And, he retired. And, he house hacked, so he kept his income to invest. And then he bird everything. So everything churn. So he was able to do it super quick. And that, you got guys like Sean Allen. They'll just borrow money on promissory notes, on mortgages, and they'll go and do it, right? So it's your comfort level. It's what you got to do. I still like joint venturing. I just think 50-50 is expensive.
It is. And a lot of times with my coaching clients, when we're planning the portfolio, sort of the position that we take is do what you can on your own to get your experience and to keep things as simple as possible. And then when you reach the point where you don't have the capital, either the down payment or the financing to be able to continue, then at that point, that's where you start looking at joint venturing. Because I have to say, it's a heck of a lot easier for my husband and I to sit down at dinner one evening and go, so what do we want to do with this property? Or, do we want to, the tenant's leaving, do we want to invest 20,000 and redo the unit? Or do we want to just, let it ride and get, a little bit less rent and not worry about refinancing to pull it back out? That conversation is a heck of a lot easier than, all right, we're calling a partners meeting because we need to make a decision with all of us together, blah, blah, blah. So my preference typically is definitely to start out and do what we can on our own. And if it's only one deal, when you take people's money, whether it's as a borrower or as a JV partner, there's a tremendous amount of responsibility associated with that. People are giving you their retirement savings. And if you are not educated, skilled, or prepared to be able to manage that responsibility, having a JV partner can be tremendously stressful. And I think you have to be in a position where, I mean, I've had joint venture partnerships. I had my very first JV partner when I started out doing rent to owns. We did them in New Brunswick, and it was not a great market. And I didn't know enough at the time when I was doing it to properly, vet the market. I did great with the tenant buyers, but the market just was the pits at the time. And I thought it was going to increase, and it didn't. And so the tenant buyers didn't buy the properties. And I wasn't willing to burn that bridge with my JV partner. So when we sold the property, I made sure they got their down payment back plus a return. Wasn't what we anticipated, but I wasn't willing to lose that friendship over the fact that I didn't know everything that I probably should have known before I took her money. That makes sense.
That makes tons of sense to me. Like I agree with you completely. It's such a huge responsibility. I'd much rather lose my own money than lose an investor's money.
Absolutely.
It's a horrid feeling.
It is,
when you're worried about that kind of thing.
Yeah. So Andrew raised a really good point. He said, please put your questions in the Q&A box so we don't miss any. If you would include the name of whom you're asking the question of, it would be appreciated. Andrew, I love how your brain works. Like, you're just such a C personality. It's amazing. Okay, so going back to our Q&A over here, Paula said, when you sell and invest profits, can they be invested with a corporation to reduce tax implications on earnings? Is this an ideal approach to consider?
So let's just re-clarify this question. Can you keep, so if it was in the corp, obviously that's a lot better, but if you own the property personally, you're going to pay tax personally before you put that money into the corp.
Yeah.
So certainly inside of a corp, you're going to pay capital gains as well. Depends if it's an active business. I used to have my flip business in a corp, so we'd pay like the 13% at the time, or 12.5%, which was fantastic, right? It's way better than doing it personally. Mm-hmm. So yes, if you're in certain active businesses, this is my experience. I'm not an accountant. Obviously, ask your accountant. But that was my accountant's advice to me, and it worked out really well.
Absolutely. Yeah. And accounting is not an area where you want to muck around hiring someone at, $5 an hour or less than somebody else. Like a good accountant is going to be worth their weight in gold and save you a ton in taxes.
Yeah.
So these types of questions are ideal to do beforehand. And it looks like Paula is saying she owns it personally.
So yeah, if you own it personally, own it personal or corp is a different decision, right? I own everything in a corp because I want to be able to personally own a cottage, buy my parents a condo, own my house without any financing implications of all these mortgages on my personal debt. Now I personally guarantee everything, yet that doesn't show up personally when I go to finance my Porsche or my cottage or whatever the hell I'm financing, right? Now, if you sell anything, any asset in Canada, you're going to pay capital gains. You pay the same capital gains whether it's in a corp or personal. And so it really just depends on what your goal is. Like if my goal was only to own 3 rental properties, and I had a job that paid a good salary, I probably wouldn't be affected. I'd probably own them personally. I probably would never put them in a corp because of the extra cost, and the extra hassle of financing and doing those types of things. So it wouldn't even be a concern. But buying rental properties in Alberta, you got to put them in a corp because it's a non-recourse province. So I have to put it in a corp anyways, just so I personally, because they'll ask for a personal guarantee. That's the only way they get the personal guarantee. So any rental property buy out there, they'd rather see it in a corp than personally.
That's interesting.
Mm-hmm.
That's interesting, because a lot of my coaching clients were having some real challenges now with buying in corporations. The lenders are making it incredibly difficult. But it's almost like the bigger you get, the more you know as an investor and as a landlord, the harder they're going to make it. When you don't know anything and you want to buy like one pre-construction condo, they're going to make the financing really easy. But when you go buy a fourplex and you already have a few properties, then they're going to make it unbelievably hard to access capital.
I'm just going to share that as you get bigger, you get into different portfolio sizes, then it does get easier. So let's look at it like a space launch, right? So at first, it's not very bumpy. You go straight up, or re-entry or whatever. And then it gets super bumpy, the G-forces are on, and then you break through and it's like, whoo, you're floating in space, right? Or you're splashing down in the ocean, whatever it is, but there's a bumpy ride in there at some point. You got to get through that bumpy ride.
So the coasting in free space, that's your equivalent to you break into the commercial market. Is that what you're referring to?
Break into the commercial market, or you can, like, I mean, there's people I know that have commercial financing on duplexes, and they get commercial loans, and it's portfolio loans. If they want to go buy another one, they just add it to that portfolio loan.
Yeah, and some of the credit unions are tremendously favorable. If you're willing to put 20 or 25% down, or 25% down on every property, as long as the coverage ratio is 1.2, they'll do them until the cows come home.
Exactly.
Yeah, the big thing, like if you know you're going to grow big and fast, I mean, I wouldn't spend too much time mucking around with the residential lenders. You can go straight into, so building in a corp, you can put 3 duplexes together. Now you're at 6 units. You meet the criteria for the minimum 5 doors that most banks have to be considered commercial. You can get 75% loan to value. You meet the 1.2% debt coverage ratio, and you could cheat, just like Mark said, keep adding properties to that and never stop. But on the note of residential, you're saying people are having trouble in corporations. I'll tell you this, I started as a mortgage agent, so I know that what mortgage agents can and can't do, and obviously things change, but generally speaking, I saw a trend in the industry that if the broker couldn't do it themselves, like the bank wouldn't pay them, they wouldn't recommend it to the client. So there might be an option that the broker would need to charge the client for in order to tell them about it, but a lot of them didn't want to, tell the client, you got to pay me 1%. But for instance, Scotiabank, if you go through a broker, they can't put it in a corporation. But if you go directly to a Scotiabank mobile mortgage person or financial advisor, they can.
CIBC is the exact same, so is RBC.
Well, CIBC won't even deal with a broker, so you pretty much have to go direct.
Neither will RBC, yeah.
Yeah, and will your mortgage agent tell you that? Not necessarily. Some are great and they're honest about it.
Yeah.
Yeah, some are honest about it, some aren't. So the thing I just wanted to put out there is make sure you know who you're working with. Ask them these questions. Say, if there's a lender out there that that can do my deal and it's better fit for me, will you suggest them to me? And if so, what price? Because hey, pay people for their knowledge, pay them for their help. Yeah. But just make sure that they're going to be forthcoming about that stuff.
Yeah, absolutely. And that's part of, going back to what you said, 30 minutes ago, Andrew, which was, choose the right people for your power team. Choose the people who have the ethics and integrity to tell you that information. Interesting. Okay, so moving on with questions here. Clara said, I have a question for Elizabeth. What has been your experience with creating lift and refinancing in the North? Well, we've done a lot of BRRRRs up here, either for ourselves or for investors. And there's tremendous opportunity. It's so funny when people from, the GTA come up, because what's an acceptable unit up here is not like it is in Toronto. A higher end unit here is something that's, clean and the floors are level and there's a backsplash in the kitchen. Like, there's tremendous opportunity to be able to buy properties for a much lower entry price. And I'm still seeing investors coming in at the 1% rule up here. The challenge with stuff up north comes in with the fact that there could be, in some markets, there's less sales transactions, so there's less comparables for the appraisal upon the refi. So that's been what I've seen as the biggest challenge. You want to buy in a market where, there's some relatively recent sold comparables, so that you can be comfortable and confident that when you go to refinance the property after the renovations are completed, that you're going to be able to get out of it a decent amount. And I think there's sort of a misconception out there that, that a BRRRR, it only makes sense to do if you pull 100% of your money out. And the reality is, someone commented the other day in the group, and it made me laugh. And he said, the BRRRRs where you pull all your money out, those are unicorns. Those are like your out of the park home run. It's not that you should count on that being the way it is for every single deal. There may be times where you leave 28,000 in or 50,000 in. When I buy properties, I'm always looking at what's the cash flow. How much am I able to pull out and redeploy? What's on my cash on cash return? I'm willing to leave a little bit more money in if I'm going to Airbnb the property and I'm going to have monster cash flow on that. That makes sense to you guys?
I would just add to that, even like I started doing similar stuff. I wasn't getting all the money out, but if I could borrow private money from an investor and give them 8% or whatever and still cash flow, I'd do that as long as I was still cash positive. So it gives you, there are people who would take that return if you want to finance what you have left in the deal. There are ways to do that.
For sure.
Kristen said, tell them to look at adjusting the property management fees based on the weather. Snow removal can be very expensive and last for 6 months. Absolutely, Kristen. It certainly can. Mark, did you want to add something to that? I saw there was a little thing there that said Mark wants to answer live, or are you good?
I've just been pressing the answer live button to get the cycle through the questions on there.
Okay.
If you do that, then it goes to the answered side.
Yeah, you're absolutely right. It does.
I'm learning.
I'm
your guy's secretary, okay?
Okay, we appreciate it. So Lorenzo said, when looking at cash flow over appreciation, would you focus on finding the area where the numbers work and invest on different kinds of properties there? Or would you identify the type of property that works for you and look for it in different areas? I love this question.
That's Mark, you start with that one.
Yes. The answer is yes.
And then it depends, right?
And then it depends. And it truly does, right? So, and here's the thing. So cash flow over appreciation. I'm looking for stuff that I can add value to. I don't, and now don't get this wrong. Like, I'm probably actually going to buy some turnkey new properties in Alberta if I can get the right deal on them. I'm negotiating that right now, but I'm buying a large chunk of them. And I think because, like, anyways, so that's just a purely cash flow play. And I think they'll appreciate in time because I think Alberta is going to do well. That's just a personal opinion. I have no other than I've done some research. So, and then, you know, you have to be comfortable with the property. So if it's buying duplexes or tris or fours, then, you know, you got to know what the type of property is, because if you want to build a big portfolio, you have to identify your property. It's the same thing as I was saying, I forget who asked about they can't find infill lots. Well, what are you looking for? Is it a 50-foot wide front with 110-foot depth so you can go build 2 semis on? Or, well, you can probably build 2 detached, right? Or is it 40-foot lots so you can build semis? Like, what is it that you're looking for? And have you identified all those in the area that you're looking? So it's kind of like one of those things where I'm looking for kind of both. I go to an area like Alberta where I'm getting a 6.6 cap on the property I'm buying, so I'm getting good cash flow. I think it's a 7% cash on cash return with my $300,000 reno budget. And, you know, I still think I'm going to get some appreciation because I'm going to go in there and I'm going to turn the units that haven't been renovated for a long time into more condo-like units. But I've always been the area that I'm looking in is getting super tight. So it's the ripple, right? So you drop the rock into the water, the ripples go out. I've always been that guy looking at those ripples. Okay, where am I going? And just happened to Hamilton I was always looking at the ripples, St. Catharines, Brantford, Niagara, and I just never got out because I would look at a deal over here and a deal would pop up right in front of me. I'm like, oh, this is too good to pass up.
How many of your deals do you think you found because you were a realtor? Does that have a positive impact on your ability to find deals?
I'd say a couple. The best deal I've ever done, 1797 Main Street, was because I'm a realtor and I just happened to be awake early. And at 6 a.m. I got a notification of this property coming on the market. By 7 o'clock, I had an offer in. By 7:30, they had signed it back to me and given me till noon. And then the other broker called me at like 8, 9 o'clock. He goes, listen, I got 7 other offers. And I'm like, I know you do because you underpriced it. But he goes, we still want to work with yours because, again, I was closing in 30 days. I had 3 days for conditions of walkthrough of all units, no financing, no nothing. So.
Interesting. Okay, awesome. Andrew?
The majority of the deals come to me because people know I can close.
Yeah.
They know me as I'm a closer. If I say yes, we do a deal.
And that's huge. I mean, this is where real estate becomes a very small world and your reputation is worth everything.
Mhm.
Absolutely. Andrew, did you want to weigh in, or shall we move on to the next question?
Oh, let's keep moving.
Okay. So Kevin says, I'm a young new investor. I'm told this is an unprecedented time in Ontario real estate. Is there any reason why I shouldn't be aggressive? The cap rate purchase prices I learned about early on feel like ancient history. That's a good one for you, Mr. Andrew.
Well, I don't think there's anything to stop you from being aggressive. I think it's about getting more creative, because it certainly isn't as easy to buy, a great cap rate. There was a time where 7 caps were easy to find, and then it became 6, and then it became 5. So the real challenge is getting yourself educated enough and becoming an expert in your area of focus enough that you can spot the deal in a second. Like Mark was saying earlier, he analyzes a deal in 10 minutes because he's an expert in the type of deal he's after. And so when you're new, network as much as you can, start tracking people who are successful in the areas you like. That's what I used to do. I talked about this on my earlier episodes of my podcast. Like, I would kind of quote unquote stalk the investor that I was really impressed by, that was clearly making hundreds of thousands of dollars on these flips he was doing. And I just learned what he knew, and I attempted to recreate it. So there are people making money in every market, and you just need to figure out how. So I still think there's lots of money to make in Ontario, but I would never veer away from your need to have that property perform as is. Cash flow works, that you never need to sell it if the market goes down. You have a threshold, or you have a buffer of cash flow there, even if rents come down a bit, that you're still going to be okay. Because if you don't do those things, you have no contingency plan. And if your property goes underwater, which is definitely possible, you'll feel like you need to sell, because you're now losing money on something that's not even worth what you owe on it. And that's a recipe to not sleep well, and never invest again. Those are things that will get people out of the game really fast. So those are the things I would never compromise on.
Absolutely. I think there's sort of an idea out there that real estate investing is easy, and especially, given what's happened in the market in the last, in particular the last 5 years, but even the last 10 years, it's been relatively easy to make money in real estate. So I think there's a lot of people who just believe that, the value and the appreciation, it's always going to happen. The reality is, when we're buying deals, we have to plan that nothing happens, or even the market decreases. And, we might not be able to refinance in a year for obscene amounts of money, right?
Everyone thinks the gravy train never stops. That's the thing that kills me. All these people that just want to invest in these cash losing markets and these cash losing assets, just because everybody else is doing it doesn't mean you need to do it too. And my mom used to say, if everybody else was jumping off a bridge, would you do it too? I don't know if anybody else got that, but every time I told her, but everybody else is doing it, she told me that.
We have the jumping bridge at the cottage, and everybody does jump off it. It's actually pretty cool.
Yeah, as long as you're jumping into something like water.
Yeah. Well, I mean, here's the thing. The answer to that question is listen, if you have a long enough time horizon, and you can get cash flow in any market, if you're creative enough with your deal, and like I can do it in Toronto. I can go buy a single family home in Toronto if I get the right deal, and turn it into a legal triplex or a legal 4 or something like that, and get cash flow. I can do that. Is that the highest and best use of my time? Probably not. Yet you can do that, right? So you can do that in any market. It's just, what's the highest best use of your time? And then what is your time horizon? If my time horizon is 30 years, then maybe doing that in Toronto, it makes a heck of a lot of sense. And I will win in 30 years. Like, I'll cash flow that property, whatever it is. And at the end of the day, 30 years, I'll look like a freaking genius.
I think that's pretty much like undeniable. You'll look like a genius in 30 years. Yeah. So the big thing there, right, to clarify, Mark, is that there is cash flow from day one though, right? So you have that buffer.
After you burr it, yes.
After you burr, sure. Yeah. As long as you have a plan to create the cash flow.
Yeah. Absolutely. Absolutely. And it should cash flow at the new higher loan amount too. One of the other mistakes I notice a lot of new investors making is they don't factor in the cost of the down payment. So they take their down payment from a home equity line of credit, and they don't factor that in. So it looks like the deal is okay. But when you factor in the true cost, that the fact that you have to service the debt that's on, some other property, then it no longer cash flows anymore. Perfect. Okay, so we've got about another 6 questions. Let's see if we can power through and try and get as many of these answered as we can. So
I see 9, but that's okay.
Sorry, you see
9.
Yeah, they seem to have expanded. They keep doing that.
Okay.
Okay, so Mark, you indicated talking to the seller could be beneficial. In the couple of deals I've done, I've never talked to anyone apart from the realtor. How did you manage to talk to the seller, and what were you looking for while you were talking to them?
I don't remember saying that. I've talked to lots of sellers. Like, don't get me wrong. I've talked to lots of sellers while I'm working with a realtor. I don't know. I don't try to glean any information from them. I don't try to, shortcut anybody. At some point, it's just a simple fact. Hey, I'm here, you're here. I think you're being a little irrational, but we can do a deal. Like, where are we going to go? At the end of the day, but I don't get a lot of information from sellers. Like, I've cold called, I don't know how many property owners in my time, and it's like, hey, do you want to sell at a reasonable price? If so, I can buy it, or I have buyers for it.
Mm-hmm.
But that's basically a conversation I have with sellers. And then if I'm there and they're there, like on inspection day, I'm not really, it's like, okay, we're on inspection day. I really don't care what you have to say most times, because I have my plan for the property, and it doesn't match what your plan for the property was, or you wouldn't be selling it. So at least not that cheaply.
Absolutely. Absolutely. Okay, awesome.
I think we've answered this next one, Elizabeth, because we were talking about it after he asked the question there.
Perfect. Okay, good. We're there. As a new investor, I have a few car loans. Wonder if I could pay those first to get my debt ratio numbers better because I'm refinancing my principal residence, or do I just go and try and find commercial deals with these loans? I would say that's a question for your mortgage broker, to be honest.
Well, I can comment on that.
Yeah.
You can structure your application that those loans get paid out when your loan advances. So when you do your refinance, they'll just pay that stuff out. So there's many solutions. I would just start with your mortgage broker. Exactly. Get the ball rolling, and let them tell you exactly how they want to do it.
Absolutely.
And if your commercial deal is good enough, then the bank doesn't care if you have car loans.
Yeah, they don't care about your personal situation, right? They just want to know that you can fund your own lifestyle without needing the income from the building.
Absolutely.
That's right. And a lot more with commercial is due to net worth. So
yeah, absolutely. Mark, what are some questions to ask JV partners to qualify and choose the right partner?
Right. So I have a 15-minute call with each joint venture partner, and it's basically, okay, tell me a little bit about yourself. Number 2, what's your net worth? How much liquid cash are you bringing? Is it liquid? Is it a line of credit? Like, I talked to one person, and he's like, well, I have my minimum threshold for this deal was 175,000. It's like, I have liquid 175,000, and my net worth is like $300,000. And I'm like, this is not the deal for you. I'm not the partner for you right now, because like I don't work with anybody who has that little capital, not that little capital, but that little net worth, because they're going to watch that money like a hawk. Whereas a guy who's investing $175,000 whose net worth is say $2 million or $3 million, it's a lot different scenario. They're going to be a little bit more patient. If something screws up, which everything always does, then they're going to be like, oh, okay, so it's not now, it's like 6 months or 8 months. Okay, no problem. That's great. Right? It's no big deal. Whereas if it's all their money, it's a big deal.
I think too, it has to do with people's level of knowledge and education. When you are someone's very first joint venture partner, both parties are going to be paying more attention to what's going on, and not more attention in a bad way, but in sort of, I find it tends to go along with micromanagement. And once somebody's done a couple of deals and they have some experience, they're ready to say, okay, you know what? I'm confident in my knowledge. I know I picked the right partner. I know I'm doing the right deal. Like, I'm willing to loosen the reins a little bit. But when you're someone's very first JV partner, like we had one, and he would call us every day and he'd be like, so what's new? And I'm like, nothing. it's a 4-unit building. Nothing's changed since yesterday. If something happens over $500, we'll let you know. But he was just so new, and it was so important to him that he literally felt compelled to call every day. So I agree with you, Mark. Sometimes it's not just the net worth, it's the level of experience that factors in.
And to be honest with you, I do like working with experienced investors because they get it. Like, they know they could go do this themselves. Maybe they just don't have the time or energy or bandwidth at this time. Whereas some people want to join venture with people like us because they think they're going to get the experience to go do it themselves, where I can just direct them to other people. They can go get the experience. You know, there's great coaches out there like Elizabeth Kelly who can help give you that experience, right?
Thanks, Mark. Appreciate it.
You're welcome.
Okay, so wow, you are like the number one person here tonight, Mark, because an anonymous person said,
I think it's the purple shirts.
Yeah, sponsored by
purple.
Adidas.
I wonder, Adidas.
No. What is the line approximately that you have to get through to that bumpy ride? So I think the anonymous attendee, male or female, is wondering, you know, is there 4 units? Is it 6 units? Like, when does the ride stop being bumpy?
It really depends on your net worth, I think. There's a whole bunch of factors in there. Get out there and talk to mortgage agents. And it also depends if you're partnering. Like, last partner I had, he was a big swinging dick. He had a very large net worth. And you might want to bump that out for when you put it on YouTube this time. But like, literally, the bank was like, oh, fees, no, for you, no fees. Oh, 75% loan to value. We don't care about cash flow. And I'm just sitting there like, who are you? This is great. And now, because I've done a lot with that person, I have the same relationship with the key bank manager. So it really just depends on who and what and how and when. But just talk to a lot of commercial lenders. Talk to a lot of commercial lenders at the credit unions, because like when I started, that's what I used was credit unions, and they got me to that next level.
That's awesome. And also that comment was awesome. All right. It sounds, Andrew, like this one's for you. Can you do a commercial loan, or if you are in a JV 50-50, but have 3 or 4 properties together? Obviously, the disclaimer part of that is you should definitely talk to your mortgage broker. Yeah. But based on your experience, is that something that's doable?
Yeah, I mean, you meet the door criteria. You're still going to need both people who are shareholders and on the company to be on the application. However, down the road, if you can get certain people out of the director positions, there may be a way to avoid having them included. I mean, of course, once you get into bigger commercial, a lot more things become negotiable. Okay, absolutely. So there's another one here. Okay, so at Jake Novas, do you have any? Oh, this is the same one, isn't it? The duplex plus the fourplex.
Nope. This is the next one. The one before was from Kristen.
Oh, okay. Sorry, I might have been merging my answer to both.
That's okay. That was efficient of you.
It worked. Okay, so yeah, duplex plus fourplex works. So Kristen, did I effectively answer your question? Because I was reading the wrong one.
You can go to the answered questions up there.
I'm trying. Yeah. Let's see here. Be at the top.
Yeah, just under answered. While Andrew's doing that, okay. So John, your buddy John, Mark is asking you to take us through the Edmonton deal, and he's got a ton of questions for your area location, units, price, cost per door. I'm thinking maybe that would be a good YouTube video. I don't know how far.
I'm just going to say it might be coming out on Wednesday at 6:15 Eastern Standard Time, so that's 4:15 your time, John. So you can go ahead and check that out on the Mark Loeffler Experience.
Sweet. That's awesome.
I'm just going to go ahead and answer Jake's comment. So any recommendations, you should be able to work with any of the big banks in their commercial lending division. You can also work with the bigger credit unions or a credit union in your area. They tend to be quite good for this type of financing when you're talking, 6 doors and more. Heck, you could even do it with less doors with credit unions. They'll sometimes even, as you pointed out, Elizabeth, do it starting at 1 unit.
Absolutely. Okay, awesome. Mustafa said, this is where less experienced investors are getting killed out of deals. I can identify a great deal from a number standpoint and I know what I'm looking for, but actually having a chance for due diligence is next to non-existent. What would you advise to us to avoid stepping on a landmine? Thank you all. Love your content. Also, what are your thoughts on mixed use residential and commercial at this point in the pandemic?
We're in a pandemic.
Mark's traveling on an airplane tomorrow.
Hey, listen, the only thing I'm looking forward to when this is all done is I always want to walk into one of my restaurants and it's full. That's all I want. I'm sick of walking in 10 people and being told I can't eat there. I want to be walking in and it's full and they tell me I can't eat there. Damn it.
You got to come hang out down here, Mark.
Well, yeah. Anyways, moving forward. Sorry, back to the question. Let me read this again. Well, it comes back down to the point, can you analyze that deal and know it's a good deal in 10 minutes, right? And then typically you'll have enough time to get in there to walk through the property, right? And you just got to know what you're looking for in terms of, it depends on what you're doing. But if you're doing mixed use residential commercial, then you have less competition than somebody looking for a duplex, first off. So you should be able to get onto the roof, check out the boiler system. You can bring your contractor. You can, I have a handyman guy that could come with me and tell me, age of boiler, go up on the roof. We can talk about that. And I've been up on enough commercial roofs where I know what's good and what's bad. And because when I did have that opportunity, or when I did buy a property, I would bring my roofer up and I would say, explain this. What am I looking at? What's good and bad about this roof? And, it might cost you a bit at the beginning, but it's definitely, you can make that stuff happen still. If you're buying a mixed use to get up on the roof, you're like, I don't need to get in any of the units. I just need to get up on the roof and see the boiler. And I don't know, I sell a lot of these things and it's like, okay, well, here's the key, go ahead.
Yeah, I have a similar experience with, the various student rentals I was burring. I just knew there was nothing that was going to come up that I couldn't handle. I'd look at the roof, I'd look at the foundation, but I also had a comfortable feeling that if anything came up, I could handle it. And it just comes to knowing what you're looking for. And that's a great point. Like Mark, you brought your trades up there. I think that's a great thing. Like first couple, I had a home inspector and I was right next to that home inspector the whole time. And then I realized home inspectors actually stop at the drywall. They don't actually get behind the drywall. So,
well, unless they have an infrared camera.
Yeah, but I had to start realizing, well, what could be wrong behind the drywall? How could I find these things? And, by asking questions, you really start to figure out how to answer a lot of this stuff. And I got to a point eventually where I never had home inspectors. I would do what you said, Mark. I even bought properties without having ever seen them. I just had my realtor. I'm like, did you see any of this stuff? Nope, didn't see it. Okay. Which I'm not recommending, but eventually you get to that level of being comfortable with the type of asset.
The problem with commercial financing is they want a building inspection report.
Yeah, then you have to do that. Yeah.
You gotta do it. It's the most boringest 2 hours you'll ever spend. I just stand in the hallway. They go into all the units, they check everything. And to be honest with you, it's actually a good exercise just for the simple fact that they're like, hey, there's a tap running in there. And it's like, okay, well, first day I own it, I'm gonna go in there and fix that because that's gonna save me money.
Yeah, absolutely.
Little things.
Awesome. Okay, so thank you guys. Appreciate that. Paula said, Elizabeth, in relation to the comment you just made, not calculating in the HELOC payments in growing an investment portfolio, is it personal preference on how long you run a HELOC balance? For example, paying interest only versus a plan to pay down principal and interest. So my preference is if I'm borrowing money from a HELOC, I want to have a plan to pay it back. If I'm borrowing, I want to be able to pay it back as much as possible when I refinance the property. If it's like a multi-unit building, then I want to have a plan to pay it back, in 3, 4, 5 years when I refinance it. The thing with the HELOC is if you don't pay it back, you don't typically have capital to buy the next one. So you really want to have a plan, a fairly aggressive plan to be able to pay it back as quickly as possible so that you can move on to the next one. Because when you're able to acquire more properties, different strategies, different markets, or a laser focused strategy on one particular market, that's where you get the growth in your portfolio. But it's also where you get some of the diversity and some of the protection against things like vacancy and unpaid rent. So when you have one unit and somebody doesn't pay rent and you're 100% vacant, you are personally on the hook for that. You have to find the money to pay your bills every month. Now, if you have 10 units and one person isn't paying or one unit is vacant, typically the cash flow from those other 9 units are going to be your buffer to be able to protect you against these, unforeseen or unanticipated circumstances. So my goal is always to be able to acquire more units. And in order to do that, I have to pay back the HELOC. So I will pay back the HELOC before I will worry about, topping up mortgages or, doing a 25-year amortization to pay the mortgage off faster. That's not my goal. I want to pay back the money and be able to redeploy it.
Yeah. And as you get more and more properties, they kind of just start cycling the money out and out and out and out. You're refinancing, like you can refinance, there's guys who refinance stuff every month now because they have so many properties. It's like, oh, another refinance. Oh, another refinance. So.
Awesome. Okay, so we have one question here from Jonathan about qualifying a tenant buyer for a rent to own. Jonathan, if you want, send me a message or send Mark a message.
You can just read my book.
Yeah, I read his book. He really outlines it.
Yeah.
And you're more than welcome to contact me as well. I'm happy to help you with that. 2 quick questions here, and then we're going to wrap up for the evening. Well, the second one isn't so quick, but I think it's a great way to sort of wrap things up. So, Andrew, what's your strategy in allocating your portfolio? Real estate, stocks, options. This actually applies to you as well, Mark. How would you decide if you were both starting with, let's say you had $1 million, how would you decide where to put it and how much to put into each of these different investment pots?
I'm going to start this off with it depends, because before this situation, before the lockdown, I would have answered this question very differently. But now when I look at this situation, I look at what are the risks and what is, I take a much more macro look at what the risks are right now. So now, whereas I would have had absolutely zero use for physical gold and silver or energy stocks or anything like that, now that's like on my radar. Buying the physical metals is important to me. Because that to me, like I'm not like a Bitcoin guy. Like I like something that's got a history behind it, and there's like 6,000 years of history there with that being used as money. So that's a part of it. But I mean, I would want as much as I could in real estate because real estate is where it can make me money. Gold and silver, that doesn't make me money. I haven't gotten into the stock hacking yet, like the options trading, like Mark does. However, once I'm educated in that topic, I'll probably allocate some to that, but that wouldn't be the bulk of my investing either. I've always been big on asking the question, what are people always going to need? And people will always need a place to live. So that was what drew me to real estate in the beginning. And I also asked, what's a really safe type of real estate? And schools came to mind because I went to school and I know whether the economy's up or down, people go to school. So I really just start with the questions and then I break it down that way. I don't have set percentages. Every time gold and silver drop, I buy more, things like that. Like it's more just, watching what's happening. And then of course, looking for cash flowing markets that I feel like, and people have probably heard me say this, but I really want to find stuff that is in kind of the essential housing category, like housing, a 3-bed, 2-bath, townhouse, or I don't really like condo fees or HOAs, but a detached house. There's always going to be a market for that. Especially if it's very in an affordable price point. So I want to own more things like that because I know even in a recession, people are always going to want that house. It's always going to be in demand. Sorry, no long-winded. I know that was long-winded, but that's just my take there.
Appreciate it. Mark, do you want to throw in your 2 cents as well?
Sure. At the end of the day, if I wasn't able to go out there and raise money through others to buy real estate, then I would put almost probably 90% of it into real estate. I'd be doing burrs. I'd be turning that money over and over and over again, buying single families, turning them into duplex, triplexes, fourplexes, and I'd be doing that all day long until I couldn't do it anymore. And the other 10% I would be doing options with buying calls, selling puts. And then slowly, as I pulled more money out of the BRRRR, because listen, I can double my money in a BRRRR in 6 months, basically. And I would then take the profit and take that and put it into options, and I would diversify, try to get to a 50-50 split at some point. If I can buy real estate with any of my own money, I put 100% of it into options and investing in small businesses as well. And I would go ahead and buy a crap ton of real estate using other people's money.
Love that. You know, honestly, small businesses need our support so much right now. It's, you know, I drive through towns around us and I just see vacancy after vacancy after vacancy. And I really feel, you know, the diversity and the culture that used to be such a flavor of our towns is so different, and so much of it unfortunately is gone. And it'll be interesting to see what comes back in its place, but it makes me sad too to see, you know, mom and pop businesses that have been there for decades and they're not there anymore.
I mean, the good thing and bad part of it is that, I mean, the Golden Horseshoe has probably lost 20,000 restaurants. That's the bad part. The good part is I still have my 3, so when this all is all over, they should be jammed, right? And we're opening 3 more, right? So
absolutely. You know, and the next time I can come down to Toronto, I'll come see you.
Yep.
That would be awesome.
Next time you make that 10-hour drive from Kirkland.
It's well, yeah, I guess to you it would be 10 hours. You're right. All right.
Yeah, I'm just joking.
So last question here, and then we're going to do the draws, or we're going to do the giveaways rather, and then we'll wrap up for the evening. So thanks for the great webinars. Well, thank you so much for attending. We enjoy doing them. I've heard that some of the current red flags, crazy bidding wars, significant appreciation in a short time, real estate prices making no sense, etc., are some of the similar red flags that were showing up in the late 80s before early 90s real estate recession, where homes were up for sale, a number of foreclosures, a significant loss of property values. What are your thoughts on this, or am I seeing it? Am I wrong in seeing this? Well, that would be, yes, go Mark.
So I actually did a video on this last Monday. I don't know if any of you caught it. Is the housing market showing signs of cracks? Is basically, we are like in December to February, the market went up 15%. It was stupid, right? There was bidding wars, 40, 50 offers on everything, and outlying areas, not Toronto proper. The Toronto proper didn't start seeing any bidding wars or anything like in the condo market until mid-January into February. And so that's starting to catch up now. But we've started seeing a heck of a lot of inventory come on the market in the last 2 weeks. We're finding that our showings on our properties we have listed are slowing down. So we're getting less showings, we're getting less offers. You know, we showed up on offer day with one of our buyers last week and we were the only one. We bought it $150,000 less than asking, you know, so it's.
Just depends.
Okay, you just
Oh,
came
We
back.
got you, we got
Okay.
you, Mark.
There you go.
Battery died on my headpiece. So it really depends, right? So even if you're in a bidding war, I've been in bidding wars and I've gotten great deals on properties. So it's just knowing what you're buying, knowing your pricing, and knowing your market really, and knowing what you're going to do to the property. And I think that we are slowing down, like the prices are slowing down. They're not going to be as heated going forward.
And
I
you
don't think we're going to see
attribute
10 to 15% increases in 2 months again.
you attribute that to the interest rate slowly rising?
Interest rates slowly rising, more inventory coming on the market. People are getting the jab now. So more people are like, oh, I'll put my house on the market. It's safer. So
Okay.
there's some of that pent up demand too, right? Of sellers. So
I think a lot of these markets were bound to stagnate at some point as
Oh.
well. Like you can only go so high and so far out of the reach of the average Canadian before that market's just going to cool off. Even if we don't see a correction, if we see a stagnation, I think at the very least we should be expecting that to happen sooner or later. Doesn't mean it stays forever. But I mean, I'm one of those people who will say, like, I believe inflation is going to become a major problem, but it doesn't mean that real estate goes crazy in every market, because if it's already too expensive for people to afford, it doesn't matter if everything else is inflating. If people can't afford it, they can't buy it. So it's going to come right back to supply and demand. But in the long run, yeah, of course, like Mark, your 30-year analogy, absolutely. But this is why, because none of us can predict This is why cash flow and a good buffer is so essential, because tomorrow your property could go down 30%. If that happens, are you still comfortable keeping it? If your answer is no, then you should probably keep looking.
Yeah. And I think the thing that people worry about is, well, I can't refinance. For years, they're refinancing with the speed that people have been refinancing with in the last 5 years. It wasn't there. It wasn't a thing. You know, you waited 3 to 5 years to refinance your property till the natural appreciation at whatever, you know, heaven forbid, 5%, right? Ooh, that's really low. Like nobody likes that anymore. 2%, exactly. But the reality is, you know, I think interest rates were a big factor, a major factor on the last housing, the crash that you're talking about in you know, the 80s and heading into the 90s. I don't see the government ever allowing 20% interest rates again. Like the government.
Well, you gotta think they have way different monetary policy now too, right? They just opened the floodgates. Back then, they're like, oh, sink or swim.
Yeah.
We're in much more of a nanny state now. So
absolutely. You guys, this has been such a pleasure. It has been awesome. I'm just going to share. Give me 1 second here. I just want to. So, Action Taker's Guide to Real Estate Investing Planner. So my friend Quentin wrote a fantastic book for those of you who are newer to the world of real estate. This is a gem. Absolutely love this one. So let's see. Mark, we had you pick last time, I think. Andrew, you're going to pick this time. Give us a number between 1 and 100. Sorry, no, we had a 55 participants. So between 1 and 55, and the person who registered between 1 and never mind. Just give us a number between the 150. There are 150 people registered there. There we go.
All right, I'll give you number 40.
Number 40. Okay, so when Mary Beth, my amazing, incredible VA, watches this tomorrow, she's going to look for registrant number 40, and we'll reach out. We'll send you a copy of Action Taker's Guide to Real Estate. Mark, did you want to throw in one of your books again too?
I don't have any. I gotta go order some. So until then, I don't want to.
All right. So we'll catch you on the next one and get another copy of your book. So here is where you find us if you liked what you heard and you want to stay in touch or connect with us if you're not already. So email address, Facebook, you can always find us. Well, you guys don't like Facebook. I love Facebook. That's the easiest place to find me. Andrew is a huge fan of Instagram. And of course, Mark, isn't there something now that I have a YouTube channel too, I'm supposed to do like, subscribe, smash the button below, something like that?
I don't know. I have no idea.
You
I say it every time now because it's just something I say now. I don't even know if it's, who knows?
It's awesome though. It makes you stand out. Guys, thank you so much for attending. It has been such a pleasure to connect with you. Really appreciate your time, not just last month, but this month as well. Hopefully everyone who attended tonight and watches on the replay really found a lot of value. Love picking your brain, and looking forward to seeing you guys in person, hopefully in the next few months.
Sounds good.
Thanks so much, everyone.
You're never coming back, so we have to go to Florida.
Come on down. It's wide open.
I think we'll be able to catch up to him when he gets back. You'll be able to run him for sure, Mark.
Yeah, for sure.
All right, guys, have a good night.
You too. Take care. Thanks so much, everyone. Good night.